The Fed is on track to cut interest rates as the labor market weakens. The U.S. Federal Reserve Fed is likely to begin cutting interest rates this month to shore up the increasingly fragile labor market. After a newly released jobs report showed that employment growth has nearly stalled and the unemployment rate has risen. Although Fed Chair Jerome Powell may approach the figure of only 22,000 new jobs created in August with caution, the rise in the unemployment rate to 4.3%, the highest level since October 2021, is sounding some alarm bells. Last month, Powell noted that with employers hiring at a slower pace, any increase in layoffs, which are currently very low, could lead to a sharp rise in the unemployment rate. The Fed will receive new inflation data next week as policymakers prepare for the policy meeting on September 16th to 17th. Consumer prices are expected to accelerate due to the increasing impact of President Trump's tariffs on the cost of essential goods for consumers. Even so, weaker than expected employment data has brought concerns over a deteriorating labor market to the forefront. The Fed has kept its benchmark interest rate within the 4.25% to 4.5% range for the past year. Economists at Bank of America said, the August jobs report will reinforce the Fed's shift in focus from inflation concerns to weakness in the labor market. Bank of America now expects the Fed to cut rates by 25 basis points in both September and December, with the federal funds rate projected to be in the 3.0% to 3.25% range by the end of next year. At the annual Central Bank Symposium in Jackson Hole, Wyoming 2 weeks ago, Powell hinted at a potential rate cut in September with remarks highlighting downside risks to the labor market, though he added that stable labor market conditions would allow the Fed to proceed cautiously. So far, the Fed has been more concerned about inflation than the labor market. But Powell's earlier speech signaled a potential structural shift toward prioritizing the labor market. Today's job data will reinforce that shift, said Oded Barber, economist at Bank of America. White House economic advisor Kevin Hassett said the August jobs data could push the Fed to consider further monetary easing, possibly with a larger rate cut this month. This view aligns with President Trump's long-standing call for the Fed to lower borrowing costs. Meanwhile, a larger than usual rate cut this month remains uncertain for financial markets. Most forecasts expect the Fed to lower interest rates by 25 basis points, with similar cuts anticipated at each subsequent policy meeting. Not all analysts rule out the possibility of a more aggressive response. The new data suggests a risk that the Fed may begin easing policy more quickly than the cautious approach Powell outlined at Jackson Hole, said Simon Dangor, head of fixed income macro strategy at Goldman Sachs Asset Management. The Fed is facing a delicate balancing act. A weakening labor market strengthens the case for faster rate cuts, but inflation risks argue against moving too swiftly. Powell is inclined to prioritize employment, but there are still divided opinions within the Fed. For financial markets, the question is no longer whether rates will be cut, but how far and how fast the Fed is willing to go.